With Walter Kemmsies, chief economist at Moffatt Nichol, who just spoke to the annual Trade and Transportation Conference of CONECT, Coalition of New England Companies for Trade. Walter, you said that inadequate infrastructure is a drag on future economic growth. Why is this?
Well, I'd like to start off by quoting that the analysis that really drew my attention, that supported the view, came from the American Society of Civil Engineers. They've published a report. It's on their website, free for download, called Failure to Invest. And they've looked at the failure to invest across many forms of infrastructure and the potential impact on the economy, looking at something like a 12% loss of GDP by about 2030. I think the most interesting thing about their report is that most of the underfunding that they've worked out is underfunding for surface transportation movement, particularly highways. And we do know that the country has problems like structurally deficient bridges. If we want to grow our exports, and our exports tend to be heavy things like agricultural goods, we need the trucks to be able to take a short route from origin to their export destination point. And if they have to take circuitous routes to avoid those bridges, then it's going to be very hard for America to be a competitive exporter, and that drags on our economic growth.
And what should be done to deal with this problem?
I think the key issue here is to make it very easy for the private sector to be able to invest in the infrastructure. Infrastructure projects have a high return, both for private investors and in terms of the great economic impacts that they have. I do think that there is an awful lot of money sitting on the sidelines that would be willing to invest in infrastructure. Credit Suisse's Global Wealth Report identifies the U.S. as having $55 trillion of wealth. And the American Society of Civil Engineers say it would cost about $2.5 trillion to bring our infrastructure back to a state of good repair. I think we can see that there is a high potential here for us to be able to do things quickly, or to have the access to the money necessary to make those improvements. But the key issue will be to reduce the uncertainty about the delay between the time when you make your investment and when the first cash flows become available. That uncertainty has to be reduced more than anything else. Not so much the time length it takes to get something done, but the uncertainty around the process.